and welcome to the Property Trio and me yet again messing up an intro, but we'll glaze over that and say hello to the lovely co-hosts Dave Johnston and Cate Bakos. How are we doing?
Oh,
Good, thanks,
I missed
Mike.
you too.
It's been a while.
Good to be back.
Yeah,
we've had a bit going on and a couple of holidays here and there, so the
Yeah.
band's back together, and it's nice to see your shiny, smiley faces.
You two must be
albeit-
feeling quite refreshed.
No, I'm jet lagged.
Jet lagged. Still jet lagged.
Still in Europe time. It's the worst.
No,
Great trip though. Great mother-daughter
Awesome trip.
time.
Yeah. My little cub and we had a good time. It was great.
And NZ, Mike, was fantastic.
Lovely. Yeah. I was measuring mountains in percentage of windscreen, and I'd be like, oh, that's a good one. That's a good 25% of that one. And I wasn't prepared for the fact that there were some that were like 125% of my windscreen height. That was a shock. You don't get that around here. But it was
Did
nice.
you do the drive south out of Queenstown with the lake to one side and the mountains all around it?
Well, I did a flight from Queenstown to Milford Sound, so I probably did even better, like went over all of the snowy peaks. Yeah, it was something else. So, I'm restored.
Oh, there you go. I'll take you and I'll raise you, he says. Flew his plane. That's great.
I'm ready to
The
dive
drive's
in.
still pretty awesome.
Oh, yeah. There was one particular day where a road was closed. I was in the glacier sort of territory and had to go to Queenstown. It was supposed to be 4 hours. Yeah. And then because the road split in two, I had to go 5 hours back the way I came and then 5 hours around the other side of the mountain range. And like at 10 hours, I'd stop for petrol and a wee, and that was it. Just rode the lightning in my Suzuki Swift, which I think should be called, a Suzuki. Look, what time do you have to be there? Not a Swift. But yeah, like it was grueling. I was knackered, but it was just such a beautiful drive that the 10 hours went, well, it felt like 7.5.
Yeah.
All right.
Very good.
Market update. So we've got the data from November, and interestingly, I think it's if I had to describe it in a short, in a quick wrap up, it's slowing. It's softening.
Yeah,
We've still got the story of those three mega markets, the Brisbane, Adelaide, Perth, yet again outperforming everywhere else. But the pace of growth has really, really dropped down, and we can see that in rents as well. But for you guys, what's the standout for the first monthly print?
Regional. What's going on? Yeah, the regions, it's all very modest here, so I won't get too excited, but combined regionals for the month, 0.3%, combined capitals, 0.1%. And I do scratch my head with that one because Perth and Adelaide are still going pretty strong. So even with all of that, obviously it showcases the fact that regional markets make up a lot of properties out there, and clearly the regions in lots of locations are outperforming. So that was my takeaway.
For me...
Yeah, go, Dave.
No, you've got something to say about regions.
I was just going to say the differential between regions and capitals in medians. We've got regions at 649K thereabouts and capitals at 897. I think, 22, 23, 24, really about affordable markets. So I'm wondering if that price differentiation is the reason why it's outperformed the capitals by 3x in the last month.
I'd say that's part of it, but we've also got a lot of activity in a lot of big regions.
What stands out for you, Dave?
Oh, look, I think that story of the big three mid-tier cities continuing to slow down. And, we've got basically every capital city slowing down or with weaker growth or even falling prices relative to the previous month, other than Darwin and Canberra. But Canberra and Darwin are still anemic growth at 0.2% and 0.1%, so they're basically flat.
Yeah.
So, the story we've been talking about, I feel like Perth and Adelaide and Brisbane are heading down towards neutral territory. And I do suspect that there'll be a changing of the guard in 2025. It's looking more certain that there'll be a rate reduction by April or May, and possibly even one in February, with some of the weaker GDP numbers and the RBA being no longer saying that there's a possibility that they could raise rates. So their language is a bit more certain around the next movement coming down. And I think, I think 2025, Melbourne, and it could be the story of Melbourne and Hobart next year, with the changing of the guard. So anecdotally, there's a lot of talk about Melbourne and all the data stacking up in terms of historical numbers and where it's sitting, how low it is. I mean, if you look at Melbourne and Hobart, they're both below peak prices by a reasonable number, 0.12%, minus 12% at Hobart, minus 5% in Melbourne. Brisbane are sort of hitting historical numbers. They actually just overtook Canberra's median value for houses. So Brisbane are now number 2 in median in houses, ahead of Canberra, which is, Melbourne down at 4th. And you also had Adelaide and Perth overtake Canberra for the median for units last month. So
that's interesting. I don't think I've seen that before.
No. Yeah. So I feel like the frothiness, it's been so frothy, it's coming out. I feel like there's a lot of changing sentiment around, investors. I think that, that data you shared, Mike, and we probably know anecdotally from our own sort of businesses, people are more willing to buy into state. And I think, investors are turning towards Melbourne, and there's a bit of data stacking up that Hobart could do well next year as well.
On your point about the interest rate reduction, which you're thinking could be before the middle of the year, it'll be really interesting to see the timing of that and calling the federal election. Those two are going to be in lockstep, right?
There's so much pressure around that. The RBA not to be seen to be impacting politics, and then the Labor government going, when should we call the election?
Yeah.
Can we hold off just until there's at least round 1 rate reduction for us? It's got to be held by May. So
May to September, is that right? Thereabouts?
I think it's got to be held by May.
Oh, before May, right?
Before May. Yeah, May's the latest. Yeah.
So they'll call it maybe a week before the RBA meeting and just cross their fingers and then, yes, watch the polls soar.
Yeah.
I mean, really, it's got nothing to do with Labor's economic fiscal policy, really. But they'll claim it.
Yeah. Well, the fact we've had no rate reductions has a lot to do with their poor economic management, I think.
Yeah. It's not just Labor. Liberal will do the same if they're in power.
Yeah. No.
One thing that I found interesting in the CoreLogic graph is when you look at the rolling 3-month change in dwelling values. I mean, you've still got 3% over 3 months for Perth, but it's a slippery dip from the top. We're talking above 6% over a 3-month period. And
yes.
and broadly, everywhere has sort of shown a similar sort of thing. Like Melbourne's got a little bit of a rebound, still in negative, but you look at Sydney, you look at Hobart, Brisbane, they're all a little bit soft like that. It's Adelaide that's maybe holding its ground,
holding a little bit, but you can't think that's unlikely to last. I mean, it's almost the biggest surprise out of those 3 capital cities, what it's done. Yeah. Hobart pops up, but it's had a blip, a strange result last month with 0.8%.
Yeah, well, you and I were both watching Hobart with keen interest, Dave, and we thought, okay, watch this space, one more data point, we'll call it. But minus 0.1 this month, as you said, it's anemic, but it's certainly not showing signs of Hobart breaking away. So I don't know what that little blip was. It's interesting because it's a smaller market and it's very seasonally driven as well. but you don't need many changes when you've got that few data points to show a trend that can throw you.
Yeah, that's right. It'd be interesting, wouldn't we? Probably none of us are going to invest the time, but you'd probably be able to delve in and find out actually what drove that 0.8% for 1 month, a bit of an anomaly, and it's probably some, I don't know, could be a bunch of high-end sales or, some high-end development that all settled at the same point in time.
Anything.
Yeah.
It's a really good point. It could be anything like that. And we might have seen vendors batten down the hatches and not do anything through a cold winter. And, that sees to fewer available stock numbers. And if you've got consistent demand, that can skew things as well.
Yeah.
There's a little graph that we've got here, which is a quarterly change in the stratified hedonic dwellings index. But essentially, it's just looking at the lowest 25%, the middle 50%, and the highest 25%. And if you look at the main market movers over this year and every market update we've done, Brisbane, Adelaide, and Perth, it's still that lowest 25% of values that's driving the highest amount of growth by, probably, broadly speaking, a third over the others.
Until you look at ACT, that's the only one that bucks the trend. At the end there, you've got your biggest price falls in the lowest quartile, and then your highest quartile seems to be holding firm.
And that probably reflects the economy. We wouldn't have any GDP growth if it wasn't for government spending, and that's sort of, in deficit, which means we're just, piling up the debt. Whereas there's no GDP growth from business or households, which is really what you need. So we've been in a per capita recession for almost 2 years, which is unheard of. Never happened before in ABS records. Now, Canberra, obviously a lot of people there are public servants. They're probably reaping the benefits of that, and it probably is reflecting in them spending more money on the top quartile of houses in Canberra, where every other capital city can't afford to do that. It's the bottom quartile that has the best results. So maybe it's a reflection of what's actually happening in our broader economy.
Yeah, possibly.
When we move the focus to rents, again, quite a slippery dipper like some of the 3-month house prices, but I mean it's a little bit more uniform across the board. I think Melbourne's probably outperforming, but from a low base. But Perth, Adelaide, Hobart, all 8.7, 6.5, and 6.5% increase respectively. But when we talk about Perth, it's coming from double digits, right?
Yeah,
so these numbers, any other precedents would say that these are huge numbers, but they've come off the boil a long way. Be interesting to take the pulse of what's happening on the ground in places like Perth, where there has been such a softening. But I'm assuming that there's still a lot of heat and a lot of pain in that market.
Well, we're still talking about positive figures here, which means there's still pressure on increasing rents across the board everywhere, even in the modest areas like Canberra, 1.2% for units. That still means that a tenant is paying a higher price in rent year on year. And use Melbourne as a case in point. You just mentioned Melbourne before, 4.9 for houses and 5.2 for units. That means that you're still getting a reasonably significant price hike each year, and it's still above what their ideal inflation rate is. So tenants are still feeling some pain.
Yeah, but I think it's telling the lag story because the rise was only 0.2% in November. So if we annualise just November's outcome, that's 2.4% per annum. And so these numbers are reflective of big jumps that happened 12 months ago, 11 months ago, 10 months ago, etc. We've been, talking about how really rental increases now are normalised, give or take. The decade average is 2%, which is probably too low. Peter Kalezos's numbers that, rents had grown by less than wages over a decade. So there needed to be a bit of catch up. But, 2% last month, November, that's 2.4% annualized. That's probably a normal level of, rental increases. And so that means that people who are looking to rent out a new property now, the increase from what it had been previously is not going to be such a large sum.
Mm. Yeah, that's a good point. You annualize November and we're sort of like almost there or thereabouts for a 25-year average, right?
Yeah. Yeah, exactly.
And so yields are very interesting. I did a podcast recently with a guy who works on the New South Wales sort of south coast, and basically sort of saying, for any of the investor grade stuff, which is coming in around the 800K sort of stuff, you need to be used to these, 3%, high 3% yields, which it just sounds very, very low. And we've sort of come off the back of hearing about some really, really solid yields around the country. But in Australia, we're sitting at 3.7% nationally, combined capitals 3.5, combined regions at 4.4. I mean, the regions do seem to have softened. I mean, there was some great places around the country, but the combination of appreciating prices and the pace of rental growth slowing has kind of fed into that, Cate, I would say.
Oh, I think there's a bigger issue here. We had really horrendous gross rental yields in regional areas because COVID created a lot of change and a lot of movement out of the capital cities, particularly in the really impacted cities, so the southern cities. And what we've always said is when you move 10,000 people, let's just say 1,000 people into a capital city, your impact on rental yield is not even close to being severe, in contrast to moving 1,000 people into a smaller city. Your percentage increase is far greater when you're taking a bunch of people and moving them into a smaller city. And so our cities were really struggling, our regional cities, that is, were really struggling with rental pressure when all of these COVID escapades were coming in. And I remember at the time, Geelong was just crazy. The properties would rent as soon as they were advertised, and the rental yield was really strong as a result because people were willing to pay a much higher price. I think that's part of it, Mike.
Yeah, that's a good point.
I think also rental yields can be a bit of a furphy at times because they're just a moment in time. And, you can have rents growing, but if the rate of the value of property is growing faster, then the yield's reducing. And, what really matters is the rate of your rental growth once you own a property.
Yep. Yeah, it's almost like a more beneficial metric would be the yield on purchase price rather than the growing market value, right?
Yeah, exactly.
Very much so.
Yeah. And then you've got to take it along with the capital growth that you've received from the property as well. So it can be a tricky one because, you can choose to buy a property that has a higher yield but then has very limited prospects of capital growth. And the reason it has a high yield is because it has historically performed really poorly in terms of growth in value as well. So it's just one to be really careful of when you're looking at it as an investor.
Yeah, very good point. Now, I want to focus in on sales and listings. I was under the impression that we were having a renaissance in listings and presumably sales transactions would come back to a much more sort of sustainable rate because it has been a little bit soft and depressed. So the annual count for the year is sitting at 527, but that actually works out to be 4% lower than the previous 5-year average for spring sales. So we are actually still down on transactions. Now, I think part of the reason in certain parts of the country is that issue of, well, where do we go to? Like if you're in Perth and you're selling, like by the time you do a deal on the next one, it could be unaffordable for you. But as things sort of slow down a little bit, do we expect, of course, removing the Christmas period, do we expect sales volumes to increase a little bit?
I think that we've got to look at listing figures and contrast that with demand. And the real question will be, will demand exceed supply? And that typically can happen in January when everyone's, agents in particular and vendors, are still enjoying the Christmas slowdown, and that pent-up demand starts to show itself usually in mid-January. And then when we start our auction season, particularly in Melbourne and Sydney where the auction markets are much stronger, we see some really peaky results at the very beginning of February because we've had all of that pent-up demand and buyers out there are saying, well, there's not a lot of stock. And it's certainly shaping up to look like that will happen again this year. Unlike past years when we worked through the Christmas season because we'd come out of COVID and everyone was just happy to keep transacting, it looks like we're going to slow down and have a proper break. When I look at these listing figures, it's actually in line with the last 5 years average.
Yeah. I'd be more. I'm not too fussed about that sort of 5-year average on the total listings number. I mean, it's slightly dipped below, but it had been above for a fair chunk of the year. So maybe that's just a bit of a tail off, but overall the whole year is probably still above the 5-year average. But I am really interested in the short-term trends of the cities, because I think that starts to tell a tale of what's coming ahead in terms of those capital cities. And
what a great segue, Dave. That's on my next sheet, so over to you.
Well, so CoreLogic actually shared that Perth and Adelaide recorded the largest lift in advertised stock levels through the spring season. So just to that story of Perth and Adelaide and Brisbane coming off and their peak. So Perth jumped 33% and Adelaide jumped 25%. So, I think, they are two really interesting numbers for me. And then, Cate has highlighted some interesting numbers, and we saw them last month as well in the listings. Do you want to talk to those, Cate?
Yeah, for sure. So when we contrast them to last month, you can see that Melbourne is slightly improved. Sydney has pulled back a little bit. Brisbane's actually got higher stock volumes than what it had, which would be interesting. Adelaide has certainly pulled back, so that potentially supports Adelaide still having some price gains if supply and demand has anything to do with it. Perth has even more listings now than what it had last week. They're at an increase of 12.7%, which is pretty sizable. Hobart, this is telling an interesting story, and it's not really gelling with the results that we saw in the Capital Growth Series. It's got 28.5% less listings, which is very significant. Darwin is very volatile in my view. Last month it was at 11.2% up, and now it's 3.8% down. That's a big turnaround. And Canberra's done a little bit of a flip as well, minus 5.8 last month, and now it's 6.3. So we are seeing a fair amount of volatility with listings, but it's not a great shock given the time of year as well.
That Hobart is an outlier, isn't it? It's a huge reduction.
In Hobart?
I know. And interesting, Dave, you mentioned peak to trough drops, with Hobart probably leading the charge there. I think you said about 12% from the peak, which is a lot higher than typically the national pullback would be from the peak. Like, we never see it go much above 7%, but Hobart has outperformed. I mean, of course, we got to remember there was quite a big boom in Hobart, but that negative 28.5% in listings from the previous year, is that an indicator of some demand coming in there?
It generally is, normally is. So normally, listings are a great precursor for what's going to happen in terms of value change. Historically, there's a big correlation. So I think, that there's a real possibility of that. Hobart, certainly the capital city that's furthest, like you just mentioned, Mike, below its peak. And I think people on the ground know that when they're looking to buy properties, because you always compare to, what did this property or equivalent property sell for 6 months ago, 12 months ago, 18 months ago. And you do naturally think you're getting a bit of a bargain when it's less than what the property or properties sold for in the previous 1 or 2 or sometimes 3 years.
Yeah, that'll be interesting. I mean, we're not doing 2025 predictions yet. That'll be an episode that'll come up after we get an absolute toweling for our 2024 ones. I think each of us will hit a few bangers for that, but I think we're all going to suffer somewhere, somehow.
Yeah.
That'll be interesting.
No one's had a clean sheet so far.
I don't think so. But, what a year. Consumer sentiment, lending indicators, we're a bit soft on data for that. But do you guys have any broad sort of insights into sentiment?
We got a little bit of information out of the ANZ Roy Morgan poll, and there's not as many measures as the Westpac Consumer Sentiment Index, but consumer confidence overall is continuing to modestly trick up. So it'd be interesting to get the Westpac data and unpack that next market update. But it's certainly not showing any negative signs as it last month.
I think the RBA meeting minutes, once we get them, might feed into a little extra rebound in sentiment because, as Dave said, they've sort of stopped that. We'll lift them if you guys are naughty and keep going to Bali and buying Range Rovers. They've sort of stopped that.
Yeah. Well, consumer sentiment did pick up a bit last month, and we haven't quite got the data out yet this month, but I suspect that'll continue to rise because we've gone such a long period without any rate increases, and it's getting more evident that the next move is going to be down and sooner rather than later.
Isn't that nice? I mean,
they're keeping a close eye on unemployment, which is interesting. And I've seen a few articles out there where they've really circled in on unemployment. So we've all been talking about inflation for 3 years, and it's actually now unemployment that's, I would say, equally, if not more, in the spotlight.
It's I mean, you think about the bottom of the cycle, we're at 3.6% or thereabouts. It's a huge increase to 4.1, but I mean that's still historically a lot lower than I'm used to in looking at that number over time.
But I think it's moved quickly, hasn't it?
It has.
And I think that's everyone's concern when we see data movement in a short space of time. You don't get a lot of time to try and re-steer the ship when you're using fiscal policy to try and control these things. And I do admire the things that the RBA board have to look out for, and the finger on the pulse that they have to maintain. And we can all be very critical of them, but these things can move quickly, and if they're not caught in time, things can really flare up.
Yeah, I mean, a big concern too is productivity.
Yeah,
and our productivity is really lagging a lot of our peers and other countries with similar economies, and that really impacts our standard of living. And our standard of living has been falling the last couple of years, and really the major drag on productivity is the public sector. And
no surprises there, Dave.
Yeah,
I mean, we've all got mates with
public sector listeners. But,
they never look as stressed as private employees.
Yeah. So the facts don't lie. Yeah, and that's where our job growth is coming from, is the public sector as well, which is only sort of worsening the problem because we're in deficit, we're growing state and federal debts, and it's the public sector that isn't being as productive in its output. So that's a real issue for us, and something that the RBA are watching closely as well.
Yeah.
Give us a deep dive on financial markets, Dave. What do you think are the big standouts? You reference a per capita recession, which is an interesting way to look at it. We don't tend to talk about per capita recessions that much. It's just broadly, are we in a recession or a depression, or we've had 25 years of no recessions, and those days sort of seem to be over.
Yeah, so look, if it wasn't for migration, we'd be in a recession, basically. And, we shouldn't lose sight of that. Bringing in people into our country, it brings in fresh capital. They are hungry to work, and that's really what's growing our GDP and our economy. But without it, we would be in a recession, and it's been almost 2 years of per capita GDP going backwards, so our standard of living going backwards, as I touched on before. That's never been seen before. We've never had this. That's why people are feeling the pain. It's why Labor, seemingly were likely to, get re-elected a little while ago, but now it's looking less likely, or more potentially a hung parliament. So, the latest data, wages growth has underperformed slightly, which is also why it's looking more likely that there'll be a rate reduction potentially even in February. And the money markets, I think they might almost have in 100% now of one happening by April. And they might even have 100% with two having happened by, there mightn't be one in June anymore, so maybe by July. So it's looking much more certain we're going to have one in the first half of next year and possibly two.
A lot of commentators are saying they've biffed it, and if the goal was the soft landing, this is actually going to be a crash landing. Where do you land on that?
I look at it's still too early to say. I think I think there's still a possibility they might thread the needle, so to speak. And unemployment is obviously one of the big ones, but I think if we don't increase our productivity, if you consider consistently going backwards in our standard of living, and our effective net income, that then that ends up being a hard landing.
I think it's tough and probably unfair of a lot of people to be super critical like that, Mike, because inflation is absolutely the enemy.
Yes. Yeah, no, you're absolutely right.
Imported inflation, you could say, I mean, in many regards, and it's a legacy of what happened during COVID.
The checkbook really came out in COVID. But, I mean, the alternative was worse. I think it's very easy to criticise the profligate nature of spending from the federal government during that period, but we were faced with a pretty terrifying situation where they were talking about potentially having 15% unemployment and lots of liquidations of businesses. And I keep saying, like, from a government that couldn't run a gay marriage referendum in an efficient way, couldn't do an online census because the tech broke. They certainly got dollars into the hands of people that needed it. I mean, there's a big argument now to say it was a shotgun and people were holding their hands out that didn't necessarily need it. But I mean, that's where we're at. I think it is too easy to criticise, and we're paying for it. We're paying for it now, certainly.
Are we ever?
You got any ideas on what we can do to improve productivity?
You know what? I reckon one of my 2024 predictions was an increase in productivity on the back of the democratization of AI and generative large language models. So I'm going to have to eat that one because it hasn't happened yet. I mean, there's plenty of futurists that said that this will outperform the Industrial Revolution in terms of productivity increases, which is, I can't think of any other productivity increase that's as massive as the Industrial Revolution. But it's just taking a lot of time. I think it's definitely changed the world that we live in, but it hasn't necessarily fed into productivity yet because the applications for it are like, okay, well, maybe Amazon is way better at telling you, oh, you bought this, like maybe you should have that. But for the small businesses, which are a disproportionate employer, it's not as easy to implement it. You can't have a team of developers and you can't train it on your data in a cheap and easy way. But I think that's the only big silver bullet that we've got, is to be able to sort of get that across everything that we do.
Yeah, and I thought that would just take a little longer to play out. I think it still has the potential to have that sort of major impact, but I think probably the rate of the technology improvements, from a practical sense, and then the small businesses and even major businesses and the individuals who work within them to take it up and really use it beneficially. I reckon humans at least tend to move a bit more slowly with that sort of adoption, and it can be more like a 3 to 5 or even a 7-year period.
Yeah, I think it'll happen eventually. Now, somebody has snuck in some data points. I guess these were GDP contributors across different sectors. So who owns this one?
This was sourced from the ABS. And the data was updated only recently, but it's from the September quarter.
Yep. So leading the charge, agriculture, forestry and fishing. So this is a huge contributor, and you contrast that to mining, which we hear about as a contributor all the time. It's actually in negative territory, but just under 1%. But agriculture, forestry and fishing is up around 6.5%. So that's very, very interesting. I'm a little bit unplugged from agriculture, from a lad that grew up in farm country. I wonder what's feeding into that.
Well, forestry and fishing, I'm not sure. Dave, you might have some ideas on this. I was surprised by this data point as well.
Yeah, I'd probably have to pick up the phone, talk to some of my brother-in-laws or uncles who are farmers. And lots of people want food around the world. Dairy, meat. Maybe it's the tariffs being released by China across the board in every area that they placed on us. They've all come off in the last 6 months. The last ones have come off. And I think
building materials. Timbers.
Yeah.
I don't know.
Yeah.
We're all clutching at straws here, but
we are.
What it goes to show though is that being the most significant data point out of everything on the list, it is a bit of a surprise. We focus often on mining and electricity, gas, water, waste,
and Dave,
transport. But
sorry, Kate.
No, you're right. Yeah, we focus on all of these other things, but agriculture, forestry, and fishing, it's a big part of our nation's GDP.
Yeah.
And Dave, you sort of flagged services inflation as one of the big drivers for inflation, probably over the last 6 months. But it seems like that's kind of unwound itself in the data. Is that an indication that the increase in unemployment is feeding into that, or international migration? I wonder, because it did sort of seem like services inflation was one of the big ones that was dragging us along with rents and things like that.
I think it's still a small risk. I think one of the services data points in the inflation numbers that came out, which were where we expected them to be, but one of the service data points still increased by 0.1%.
Right.
So it's still a bit of a risk, but I think overall there's enough movement in the right direction. Like housing, for example, fell quite significantly, and that I assume is partially with the fall in rents starting to feed through into the numbers. So, yeah, it's still something we need to be careful of, I think, services, and it's something that's propped up our inflation numbers for longer than we would have liked.
What about the energy rebates? I've seen a couple of energy bills come through for myself, and the rebates popped in there, which is lovely, but I can't remember what the announcement was, but that's obviously going to have a limited shelf life, and that'll push itself back into inflation.
Yeah. So, look, I guess basically what happens is the economists pretty much aren't looking at the high level because it's artificially reduced by these energy rebates, and so then they're just looking at the underlying inflation, and that pretty much then removes the energy rebates from the picture.
Yeah, right.
So the serious people aren't really factoring that in.
Well, I guess that was November, the month it was, and if we categorise it, we've still got those three markets galloping away, but they're more of a canter, and maybe they're going to stop for a drink at some point. This is a terrible metaphor. Who can do better?
Well, I'd say they're sort of slowing down. They're still a bit of a way in the distance from the other 5 capital cities, but they're getting closer. Like that.
And nationally, what are we talking? 5.5%, was it? I mean, that's something that we're much more used to across the board, but it's just a tale of different cities, isn't it? Like I feel like the disparity is really there. And yeah, annual change in dwelling values 5.5 nationally, regionals at 6, combined capitals at 5.4. I mean, that's typically sort of an average number for a growing market across the board, but without those 3 cities, Brisbane, Adelaide and Perth, we're nowhere.
Well, it just highlights the fact that there are markets within markets, and we don't all move in sync all the time.
Yeah, I think there might be a baton change in 2025.
Well, we'll be here to guide you through it, absolutely. And of course, we're going to have to get our 2025 predictions out there. So I'm looking forward to having egg on my face early 2026, where I explain how I went wrong. But first, we've got to explain.
Well, you don't have to wait that long. Yeah, exactly.
Yeah,
we'll all have egg on our face.
We got that one coming
early
up.
2025. Reviewing our 24 predictions.
Yes. And if you've got some predictions, throw those in the comments, because almost certainly if you get it wrong, we'll read them out just to take the heat off us.
Yeah, send us through any of your predictions for 2025
We'd love to hear from you. And if you absolutely nail it, I don't know, we don't have any merch, but maybe
we'll give you a
make
prize.
We'll get some merch.
Yeah, we'll put together some merch.
Beautiful. All right, guys. Thank you very much for November, and we'll see you next week.
See you next week.